Let me now bring on board Gautam Chowchuria, Head of Small and Mid-Cap Research with UBS India. Gautam, the good news here is that risk is no longer occupying global center stage, but the bad news here is that the regulatory environment is still very, very challenging and choppy.
Yeah, good morning, Nikunj. Yeah, that is the reality right now, and I think the regulatory environment is a tough one to call. We've all been hoping for a long time that it will turn. But it becomes a big political call also. But the new hope is that post the presidential election thing behind us, you will see some improvement on that. But again, there also we are seeing some progress in some form, in the sense that we saw some coal block clearances happening a couple of weeks back. Possible news flow on the telecom seems to be more towards a resolution rather than continuing dilly-dallying. So there's still hope that post-presidential elections that will improve at the margin. From the global perspective, I won't necessarily agree that the risk is completely off the center stage. It's still a risk off market in broader sense. Tactically short term, you do see short squeeze rallies in global markets. But let's not confuse that with risk on. I think the global investor sentiment is still in a broadly risk off mode. They don't want to be caught on the wrong foot in a short squeeze up, and that's why a lot of investors do try to participate in any tactical up moves and not be overly short or overly negative on markets. And same thing applies for India. When I talk to investors, a lot of investors, even though not being very bullish on India near term, they also worry about what happened in January and February when Indian markets suddenly shot up, outperforming a lot of the other regional markets. So they don't want to be caught in that position. So despite being not being bullish India in the near term, they're not necessarily big underweights on India. So they talk about being underweight, but our guess is it's more a marginal underweight than a big underweight.
Gautam, what is your sense? Do you think we may see some move on diesel prices post the presidential elections?
So that's the hope. Again, this is my guess is as good as yours, but that's the hope. And in terms of statements coming out from the economic advisors, from the government, from finance ministry, we haven't seen any statement which seems to indicate that they want to back out of that. So I think it still is a political call for them. And in terms of political calendar, post presidential election, the political calendar is definitely light, with parliament not being in session, other state elections being towards the end of the year. So it is a big window for them to do a lot of things. So that's a possibility, yes.
Gautam, let me construct a scenario, and more like a 6-month scenario. Next 6 months, we get very little positive news from New Delhi, but global commodity prices, they correct, and European problems are sorted out. What happens to India in that environment?
So Indian markets will still do reasonably well, because valuations are no longer expensive. They're not cheap. They look optically cheap, but they're not cheap. But they are reasonable. And despite, as you've seen over the last 3 quarters, despite one of the worst macro environments locally, forget global, even locally, we have seen corporate earnings being very robust and delivering growth. So the growth is lower, but there's still growth, and there's still reasonable growth levels, which will continue to happen even going forward as per our view. The macro slowdown will impact earnings growth at the margin, but not significantly. In that context, if global commodity prices ease off, and especially crude, then it takes away a lot of the cost pressures which a lot of the corporates have faced over the last couple of years. So they have been able to tide over that cost pressure by increasing prices and maintaining margins broadly. But with that commodity prices easing off, that gives them a good lever to maintain profitability and possibly even surprising earnings next year.
At a time when commodity prices have corrected, are you recommending your clients that it's time to buy commodity consumers, airlines, battery companies, autos, capital goods, machinery stocks?
So we don't cover airlines as such, but yeah, agri names we are definitely recommending. Not just because of commodity prices easing off, but also because a lot of the agri companies' demand trends, which we saw being impacted over the last couple of quarters, in a way it is backward looking. You had very bad monsoons in South India, and which again it can happen again, but as of now the outlook looks okay. So a lot of the concerns on the stock price and earnings is backward looking, so they look attractive to us. Auto components, again, companies like Exide is one of our top picks, and again, if lead prices ease off, then it's a big positive for them, because we saw the last year they were impacted by volatile lead prices, especially in a slightly muted macro environment where demand is not so strong, any commodity pricing pressure is supportive of margins.
What makes you bullish on agri companies, and which part of the agri cycle you like? Do you like Rallis, which is a pesticide company? Do you like Advanta, which is a seed company? Or you want to keep it simple and safe and you like generification?
No, we prefer Coromandel and Rallis actually for the simple reasons that they are exposed to the growth part of agri commodities long term. Agri in a way in India is evolving, still early days of demand penetration and usage patterns. So farmers are still moving up the usage and value add curve, so to say. And these two are the top beneficiaries of that. Coromandel as a complex fertilizer manufacturer, and also as other non-fertilizer inputs like crop protection, etc. And Rallis as a broad-based crop protection company. So these two are at the forefront of participating in the opportunity thrown up by farmers moving up the value chain.
What makes you bullish on Rallis? Because some other HNI investors are also bullish on Rallis. But if I map what they've reported for the quarter gone by, margins were down, sales were under pressure, and the management commentary was okay.
Yeah, so it's the same thing. Basically, last 2 quarters have been tough for these guys because of the weak monsoons in South India, and which has impacted the demand environment for both of them. So they did face revenue growth pressure as well as margins pressure. But again, that is backward looking. We expect that to correct. Maybe not in the first quarter numbers, but over the year that will correct. And so whatever they've delivered over the last 3 to 5 years, that should start coming back again for them this year. And in that context, the stocks, because they have corrected, look attractively valued.
Gautam, what's the view at UBS on banking as well as rate sensitives in light of the RBI now changing its stance to a more dovish status on the monetary situation, or rather the policy situation?
So I'm not sure whether RBI has actually changed the stance. We just had some hint that they're open to more easing. But again, our stance has been that 2012 in general is much more supportive of monetary easing from RBI's point of view versus monetary tightening last year. Now, monetary easing can take the form of liquidity support in the form of CRR cuts, OMOs, or in the form of repo rate cuts. So if you look at RBI's actions, etc., they have been quite supportive of having necessary liquidity around in the market in terms of CRR cuts and OMO. So that will continue. In terms of rate cuts specifically, that's a much more stronger call to make, and that depends on actually inflation and fiscal part. So that we don't really expect an immediate rate cut in the next policy unless you see Brent prices crashing big time over next week or so. So there we still have an official view of 50 basis point cut towards later part of the year or early next year. In terms of changing the stance and impact on banking, our top-down view is that in the next quarter or so, we are still in the growth reset phase for India in terms of expectations, and therefore it's not the best period for investing in growth-linked sectors like banking. From a banking analyst point of view, bottom up, I think our view is that we have seen the worst of NPL cycle as well as NIM compression behind us, and valuations are supportive. So it is a great time from a banking bottom up perspective to start adding. But from a top-down portfolio positioning, I'll recommend waiting for a quarter or two more to start being aggressive in that. But again, there are bottom-up ideas which we like, which we continue to push, like ICICI Bank, Federal Bank, IndusInd Bank.
So Gautam, do you not think that this time's GDP shocker as well as the crude decline has given the RBI elbow room enough to cut the prime lending rates, or rather the repo as well as the reverse repo?
Not enough window, but it can always try to be proactive and ahead of the curve in trying to cut rates. So I think if they do that, then they will be taking a view that, or the presumption will be that they expect crude prices to come off. Because if you look at current crude prices, the current inflation trends and current fiscal direction, there's not enough elbow room to cut rates. But the fixed income markets are already pricing in a 25 basis point rate cut, possibly, and there's already talk about that. So RBI can always take a proactive monetary policy, which they have done in the past.
Okay, Tata Motors, 236 rupees for Tata Motors. Gautam, UBS India got this one right. My compliments. What's the way forward for Tata Motors?
Thanks for that, but I think our auto analyst view is that two parts. One, JLR expectations are still very high. in terms of volume and growth trends for next year or two. They've got the business, they've got the product portfolio right, but the expectations are still running high. And if you look at the implied valuation for JLR, and if you strip out the accounting differences for R&D and for pension liabilities, etc., it's trading at a significant premium to its comparable peers like BMW and Audi. For the India business, that's a recent concern for us. We've seen macro slowdown continue, and for last 3-4 months we've seen the CV cycle weakening a lot. So again, there is one area where we could see some negative surprise over next couple of quarters. So we're still not in the camp of looking at the stock positively. We still have a sell on the stock.
Okay. The other stock, Gautam, which I want to discuss is Pantaloon Retail, and I remember reading a report from UBS India where you have a buy call on Pantaloon Retail. Now, a month ago, the problem for Pantaloon Retail was too much of debt and the management was doing nothing about the debt. Now that they've sold some of the non-core businesses, markets are of the view that all the good business is gone, forget the debt, growth is now a concern.
So I think, yeah, you put it right. I think the bigger issue now is to get growth back on track. And it's not an easy thing. So we've had the company management talking about focusing a lot more on operations of the remaining businesses. So that holds the key really. From a leverage point of view, they're in a much better shape. But whether they are able to turn around and get the remaining businesses operationally on a high growth path, difficult task, especially given the macro environment. But they are the early leader and pioneers in that space. So that's the hope for the stock.